Hi, Mike Flores here, co-founder of Trade Prosper. Welcome to Section 7, Video 6, putting it all together to trade the 55-day channel breakout. So far, you've learned the background of the channel breakout. You've learned how to use the 55-day and 20-day lines, how to filter the trades, and how to manage the stop losses. In this video, we're going to put it all together. We're going to start by looking at ticker symbol TSLA, or Tesla Motors. Now, this is a stock, so what is it that we need in order to have a valid entry? Let's take a look at that first. Okay, so what do we need? Well, first we need a sideways setup, which is a 55-day horizontal line for at least 1 week of trading or more. We need a rising ADX line, which means we need a blue line on the ADX, which indicates it's rising. We need price to be near either the 55-day high or 55-day low. And then we have to identify our stop loss method. If we're trading futures and Forex, we're going to use the last bar or CFDs. If we're trading stocks, we're going to use the 20-day line. And we're going to use ATR for any one of the markets that we traded. So our first example is going to be Tesla. So we're going to use the 20-day line as our stop loss method. Now we have to figure out what our entry order and our stop loss order is going to be. And then we simply wait for the market to trigger the trade. Okay, let's go back to the chart and take a look. Okay, so first we said we need a sideways setup. So here on the chart, we have more than 5 days, we have more than a week of trading with a sideways horizontal black line. So therefore we have a sideways setup. We need a rising ADX, and we can see that we have a rising ADX here, and then it goes down, but then it rises again. And we have the price action getting closer and closer to the 55-day high. So this top black line is the 55-day high, and the 20-day high is overlapping the 55-day high. Then we have the 20-day low down here in red, and the 55-day low down here in black. And then we have the green and red price action bars. So on these days, we would start placing our orders to buy on a breakout of the high, but nothing happens for a couple of days. And then notice on this day, we break out. It breaks the horizontal line. The price action breaks out. But let's go through an actual example of what the order would be. Okay, so on this day, the latest day before the breakout, our order would be to buy on a break of the 55-day high plus the cushion. So if you look to the left of the cursor, the first box at the top says the 55-day high is 46.68. So we add the cushion. For stocks, we said we'll use a generic 0.10 or 10 cents. That makes our entry level 46.78. That's the stop loss entry level. We will buy on a stop loss entry at 46.78. And our stop loss will be the 20-day low on that day. Now on that day, the 20-day low is 35.16, which you can see to the left of the cursor. And we've got to take away the cushion on that level. So therefore, the stop loss level will be 35.06. So on the screen, you'll see I've written this all out to make it very simple. On this day, our buy stop loss entry would be the 55-day high at 46.68 plus the 10-cent cushion, which is 46.78. Let me move this a little higher. Now you can see the 55-day high below to the left of the cursor. And the sell stop loss is the 20-day low on that day minus the cushion. So now you can see everything there up on the screen. Okay, so let's take this trade on through the life cycle. So the next day, the market breaks out above 46.78, and we're in the trade. Now our stop loss the next day also moves a little bit higher. The 20-day low is now 35.74. So on that day, we adjust the stop loss to that low minus the cushion. And we continue to follow the trade along, and we continue to adjust the stop loss along the way. Now notice over here on this day that we crossed the 40 line in the ADX. And remember the ADX turn rule. Any day that the ADX is above 40 and turns down by any amount, we exit the trade. So we keep watching the trade as it goes higher. We adjust our stop loss every day as the 20-day low goes higher as well. You can see the 20-day low is going higher every single day. So you're going to keep adjusting your stop loss. And then over here on this day, here, you see that the ADX turns down. The previous day's level was 64.90, and on this day, the ADX's level is 64.35. So at the end of this day, market on close, you would exit this trade. 92.73 is where you would exit that trade. Okay? So you got in at a break of 46.68, and you exited at 92.73. That's a really nice move that you caught right there. Then you wait for the next sideways setup, the next ADX to be blue, and the next breakout level to be near either the 55-day high or 55-day low. And you look to repeat that in Tesla again. Okay, so that's how you use the 55-day channel breakout with the 20-day low as the stop loss for stocks. Let's move on. Okay, now we're going to look at the heating oil futures. So we've identified the market we're going to look at. So you can either trade heating oil futures for those of you in the United States, and for those of you outside of the United States, you can trade heating oil CFDs. So looking at the chart, we see here we have a sideways setup. We have 5 days of a horizontal 55-day low, right? You can see that's the 55-day low. Here goes a 20-day high above that. As I click on this line, you can see the 55-day low and the 20-day low overlap if you look to the right of the cursor. And here you have a sideways setup. You have a rising ADX, so you can place your order on this 5th day. So you would place your order to sell at 2.7117 minus the cushion. And your stop loss of the day, your projected stop loss, would be the projected last bar, which is the high of this day. The next day you break out, so now you short this market, and you adjust your stop from the projected last bar to the actual last bar, which is the breakout day. Then you ride the market accordingly. Now, let me show you the actual levels. So you see here I have the sell stop loss entry at 2.7117, which is the 55-day low, minus the cushion, which in heating oil is 0.0005. Now remember, this is going to be in the supplemental content section. You will see an example of cushions that you can use, but just remember the cushion is literally, it can just be simple as the bid-ask spread, the difference between the bid-ask spread for the market that you're trading. So the entry level would be 2.7112, which you see here. Your stop loss would be the projected last bar of that day, which is 2.7537 plus the cushion, 0.005. So your projected stop loss on that day would be 2.7542. And on the actual day that you break out, this next day, you adjust the stop loss to the actual high of that day, which is 2.7327 plus the cushion for 2.7332. Okay, so we're in that market now. Now let's move on. So we're in the market, we're short, and we now follow along. We see the market's breaking lower. We see the ADX continues to rise. We get above the 40 line here on this day. So now we start to monitor that. And we see we're trading along, and then on this day here, we get a red ADX. So we exit market on close. And that exit level is 2.5017. So remember, we said we entered on the break of this low, which was 2.7117. That's where we got short at. And then we bought back that short position on this day at the close at 2.5017. Okay, now remember, to calculate that, we literally just take the breakout level, which was 2.7112, because don't forget the cushion. And then we exited at 2.5017. Okay, now that's a really good move there in heating oil futures. So if you don't know, one contract of heating oil futures controls 42,000 gallons. So you take the difference between your entry level and your exit level, and you times that by the multiplier. Let me show you. So what you see on the screen is our stop loss entry level, 2.7112, and our exit level due to the ADX turn rule was 2.5017 on that day. You can see that close there to the left of the cursor. 2.5017. So the difference between the entry and the exit is 0.2095. Your profit is equal to 0.2095 times the heating oil multiplier, because remember, futures contracts have standardized values, and the multiplier for heating oil is 42,000 gallons per contract. That's how many gallons you control with each contract of heating oil, for a profit of $8,799 per contract that you own. Not bad. All right, let's move on to another example. Okay, so for our next example here, we're going to look at the crude oil market. We see we have a sideways setup. We have more than 5 days with a horizontal black 55-day low line, which you can see to the right of the cursor. You can see the 55-day low and the 20-day low overlap. You can see the 20-day high up here, and the 55-day is further up. So we place our order to sell. We can start placing that order here on this day because we have the blue ADX. Nothing happens on this day. Then we place it again the next day, but we're going to use a different stop now. Now let's talk about using the ATR stop. So to add the ATR, remember, we're not adding it on the price chart, so we won't click this wrench. We'll click here, and it pulls this up. We choose our 2 times ATR 21. We hit add. This pops up. We don't need to change anything here. We X that out. I'm going to resize the chart to make it a little easier to see everything. Now we have that up on the screen. We have the ATR and the ADX. Now let's go through the trade. Okay, now that I've put on the ATR 21 at the bottom, the 2 times ATR 21, let's go through it. Our stop loss entry is on that day at 94.28, which you can see to the right of the cursor, the 55-day low, minus the cushion, which you can see on the yellow sticky note. That means our entry level is 94.25. Our stop loss on that day is going to be the close of that day, which you can see is here at 96.24, which you can see to the right of the cursor, plus the ATR 21, the 2 times ATR 21, which is here at the bottom. And on that day, we can see that that level to the left of the cursor is 3.9466. So I rounded up to 3.95, you can see on the post-it, on the sticky note. And that makes my stop loss level 100.19. So now we're in the trade. Let's follow along. We're in the trade. The next day we have a new lower close. So what do we have to do? We have to adjust the stop. So the new stop on this day will be the new low close, 95.25, plus the 2 times ATR, which if you look to the bottom, if you look at the bottom, you can see the bottom left box says 3.988. And I'll round that up to 3.99. And now my new stop loss will be 99.24 the next day. So remember, when we have a new lower close and we're short, we adjust the ATR. This day, we have no new lower close, so we don't change the ATR, we don't change the stop loss. This day, we have a new lower close, so we change the stop loss again. The new lower close is 94.44. And we add the ATR, which you can see at the bottom is 3.91. Now our stop loss on this day is going to be 98.35. And we continue on. Another new low close, we adjust the stop. 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 So on and so forth. Now what happens is we don't get stopped out on any of these trades. You get stopped out over here on the ADX turn. Now the ADX turn level, you see here we go from blue to red on this day, and we are above the 40 line. So you would exit the market at 87.72. So what I've done now is I've shown the entry. We got in on this day. The level that we got in on was the 55-day low, 94.28 minus the cushion. so 94.25, and we exited on the close of this day because of the ADX turn at 87.72, and you can see that up here on the sticky note. So the profit is 6.53. We times that by the crude multiplier, and you would have made $65,300 per contract in a few months. Now that's an awesome trade. Now, some of you might not be able to trade crude oil futures because you don't have a big enough account. Maybe you can only trade, you can't afford the margin on crude oil futures. And if you don't know what margin is, then you can find out about it in the next section. But for those of you who can't trade crude oil futures, you can trade crude oil ETFs. And there's a bunch of crude oil ETFs that you can look up. And so whether you can afford to trade futures right now or not, you can still take advantage of a move like this through ETFs, CFDs for people outside of the United States, or direct through the futures market. All right, that's it for now on how to tie it all together. I've given you 3 examples using the ATR, using the 20-day low, and using the last bar. In the supplemental section of this course, we also have the ebook, which explains all of this stuff written out. So if you're someone who likes to learn visually, you can look at the ebook and learn as well. Okay, so that's it for this video. I'll see you guys in the next one. We're going to move on to the next section. Talk to you soon. Bye.